So welcome to financial accounting class. So this one will be our first topic, topic 1 of the financial accounting. So under topic 1 we shall talk about the nature and purpose of the financial accounting, objectives of the financial accounting. Then we shall talk about the elements of the financial statements, then the basic accounting equation. Then we shall finish with the users of the accounting information. So this one is financial accounting. Financial accounting. So the first subtopic is the nature and purpose of accounting. Nature and purpose of accounting. Now in this section, we shall define what is accounting, what is financial accounting. First, so let us start with the definition of the financial accounting, and we say refers to the process of identifying, measuring, recording, and communicating financial information in order to permit users to make informed decision. That is the main definition. So we say refer to the process of identifying, measuring, recording, and communicating financial information in order to permit the users of this information to make informed decision. Make informed decisions. Now you need to analyze to underline the word identifying, measuring, recording, and then communicating. Now identifying is to identify the transaction. So you identify first the transaction. Once you identify the transaction, then you need to measure the transaction. Then you record the transaction in a particular account. It can be a ledger or the journal. You start from the journals, from the books of original entry, then to the ledger's account, then to the financial statement. Once you have the financial statement full, then you can do what we call the communicating those statements to the users of this information. Now communicating can be the process of communicating the information itself, or the process of analyzing those statements using particular metrics so as to give more details to the final user of this information in order to help them to make what we call the informed decision. Now, from this definition, then we can talk about the phases of the accounting process. Phases of accounting process. So the phases of accounting process. So number A, or the first phase, is about the recording phase. And what does the recording phase entails? What does the word recording phase entails? We can say it uses the book of the original entry. It involves using books of the original entry, using books of original entries. So books of the original entries, or what we call the, you can also call them the, or the journals, or simply the journals, or simply the journals. We'll talk about the journals later. So these books of the original entries or the journals, we shall talk about them later, but we start from the books of the original entry to record the financial statement, or from the journals to record the financial entry or the original entries. To record financial information, record the financial information, establish accounting rules and procedure, establishing accounting rules and procedures, accounting rules and procedures. And procedures, this pen of mine, it is writing in a way, anyway, it is not bad. So we'll talk about the recording phase. So that is the point, the first point of recording. So the first point of recording transaction, we start from the books of the original entry, or simply what we call the journals, to record the financial statement. Now once we do these recordings, our next item is to do what we call the classifying phase. So classifying phase, classifying phase, classifying phase, classifying phase, classifying phase. So classifying phase. So when we talk about the classifying phase, we are talking about in most cases sorting the information or grouping the information together. So we sort a similar item, or we group the similar item together. So let us write and say, it involves sorting. It involves sorting and grouping similar transactions. Similar transactions into respective class, into their respective classes, by posting them to what? Now, the only way we can sort these groups together is by sorting them using a particular account. That account is what we call the ledger account. So ledger account is the account that is used to sort account together. So it is account that is used to do what? To sort similar account together. So similar account will be recorded into a similar account with the other. For example, all items of the PPE, for example, property, plant and equipment account, can be sorted from a ledger T account. So we can record all the PPE account. Then all the account of, for example, depreciation account. Let's say talk about for example, the accumulated depreciation account. So all the information concerning the accumulated depreciation account can be sorted together in one account. So that's what we call the classify. So we classify each item or each transaction according to their relevancy, where they belong, or according to their group where they belong. So that is number 2. We call it the classifying. Then number 3 is about summarizing. Number 3 is about summarizing. So number C, talk about summarizing. Summarizing phase, and we say, so it involves preparing the final statement or the reports. So it involves coming up with the financial statement or the reports. So we can say it involves coming up, preparing, let's do the word preparing a financial statement and reports. So this can be done on a monthly. You can say it can be done on a monthly, quarterly, semi-annually, or annually basis. So annually basis. So the statement can either be recorded. So how do we summarize the transactions? So once we classify the information, we shall realize that we shall have a lot of classification in terms of the from the part of classifying. So classifying brings about a lot of classes of assets, classes of liability, of expense, of income. So we shall have a lot of information, but that information is too big to be digested just without summarizing. So we need to summarize them so that we put the total of items in the income statement to the income statement, and the total of assets to the balance sheet and equities and so on. So we try to now move from the big transaction where they have categorized them into one big total. So for example, revenue, we can have revenue from various sources, revenue from customers, revenue from the related transactions. So all those are similar transactions in the same group, but we now want to categorize them into one so that we have just total revenue. So that one is through summarizing. For example, for PPE, so we might find that the PPE has a lot of transaction inside. We shall have maybe plant, we shall have the equipment with their totals, we shall have maybe land, building. Now all these items, they belong to PPE. Now it is very hard to summarize, to know or to use this information for the purpose of interpreting. Now what we do is that we come up with the total figures of the PPE that will be used or will be taken to the statement of the financial position so as to be used for the purpose of analysis. And that's what we're talking about. We summarize them so that we can come up with just a single statement that can be used to explain those amounts. Now once we do summarizing, then we can do what we call the interpretation. So interpretation phase, no, this one will involve summarizing the financial statement using various tools. So it involves summarizing the financial statement using various tools, and the most common tool is the financial ratios. So we say refers to the analyzing or the analysis of the financial statement. i.e., so we can use various component, i.e. financial ratio. We can use the vertical statements, vertical common size statement. We call them the vertical common size statement. We have the horizontal statement, we also call the trend analysis, etc. So etc. So those are some of the phases that you can find when we talk about these phases. Number 3, or the next item that we shall talk about, when we talk about the nature and the purpose of accounting, is about the branches of accounting. Branches of accounting. Branches of accounting. The first branch is the financial accounting itself. We have defined it, so I'm not going to define it again. Financial accounting. Now, financial accounting, as we have said, it is the process of identifying, measuring, recording, and communicating financial information so as to allow the users. So the keyword here is the word users. So you need to understand the word users and the informed decision. So when we gather, we process, we summarize those information, then those information will be used to assess the users of this information to make informed decision. We shall talk about the users later, but purposely when we talk about financial accounting, because financial accounting is an external body, it's an external reporting framework, then it is important that this information becomes helpful to the users of this information. So that's number one. Number two, we have the tax accounting. And what is this tax accounting? Now, when we talk about tax accounting, it is an accounting that deals with the determination of tax liability. So this so we say it's a branch of accounting that it deals with determination of tax liability. Determination of tax liability. So how much in terms of tax are we supposed to pay during this financial year? So that department, we call them the tax accounting department, is the one that deals with the determination of tax liability. Now, not only the tax liability, so it is not involved in determination of tax liability alone. It also it is also involved in determination or in compliance of the tax policies that that is required by them. So sometimes you find that the government requires that the company to comply with the tax rules and regulation or the policies. So it is also the function of this department or this tax accounting to make sure that the company complies with the relevant tax authority when it comes to payment of tax, when it comes to issue of the tax return, and so on. So it's not about the determination of tax liability, it also go to an extent of compliance. So the company need to comply with the taxes. So examples of those taxes that that they need to comply and pay. So for example, corporate tax. So they need to pay corporate tax and comply with the corporate tax rules. VAT and maybe pay for the employees. So each employee need to pay the pay as you earn. So that are some of the tax. That's the main function of tax accounting. We talk about tax accounting as a branch of accounting. Then we have the cost accounting. Now, cost accounting focuses on ascertainment of cost alone. So it deals with ascertainment and determination of cost. That is their main function. So we talk about cost accounting, and remember, cost accounting, this one is an internal affair of an organization. It's an internal affair. So when you talk about it is the ascertainment and determination of cost internally. So you may look at the word internally. So we are supposed to have the word internally here. Internally. So when we talk about cost accounting, it means that this is an accounting that deals with the ascertainment and determination of cost internally. When we talk about internally, we talk about within the organization. Then we have number 4, management accounting. Management accounting. Now for management accounting, this one purposely deals with a decision-making process of the organization, also internally. Remember, also internally. Remember, cost accounting and management accounting, they are related fields, so they work hand in hand. They are brother and sister. So this one deals with decision making process about cost provided by the cost accountant. Provided by cost accountant. Now remember, when we talk about cost accounting, cost accountant are the people who determine and ascertain cost within the company. So they are there to determine cost within the company. Now that cost is forwarded to the management accountants. Now the management accountants, they are there to make decision based on those costs provided by the cost accounting. So when we talk about the management accounting, it deals with the decision making process about cost provided by the cost accountant. The last one is auditing. Auditing as our last component of our last component of branch of accounting. Now this one deals with the vouching and verification of transactions. So it deals with vouching and verification of transaction. Verification of transactions. So that's the main work of the auditing. So they are there to make sure that the information provided by the accountants, they are free and fair from immaterial, or from material components. Sorry. So so they are there just to verify that, to make sure that the financial statements are free and fair from errors and material. Now that one is okay. Now let's go to the users of this information. So number next, apart from the nature. Okay, we are sorry. Before we go to the users, we need to go to the even the users. The users will be the last information. Objective of the financial accounting. Objectives of the financial accounting. So that's number 2. So allow me to wrap this part so that we can talk about the objectives of the financial objective number 2. Of financial accounting. So objective of financial accounting. Objectives of financial accounting. So let's see some of the objectives of the financial accounting. Number 1, so financial accounting, it helps know the performance of the company, So how do we know the performance of the company? The performance of the company we can tell the performance of the company through the income statement. This can be achieved through analyzing the income statement. the income statement. The income statement is the profit and loss account. So the profit and loss account. Number two, it helps to know the financial position of the company. How can this be achieved? By analyzing the statement of the financial position or the balance sheet. Statement of the financial position. By analyzing statement of the financial position or the balance sheet. So the financial position. The first one, this one is supposed to be financial performance. This part, financial performance. So it helps to know the financial performance of the company. It also helps to know the financial position of the company. So financial performance of the company can be achieved. So we can analyze the financial performance through the income statement. Then we can analyze the financial position of the company by analyzing the financial statement of the financial position or the balance sheet. Number three, it helps to know the movement of cash. To know the movement of cash during the year. How can you achieve this one? Let's do the statement of cash flow. This can be achieved through the statement of cash flow. Statement of cash flows or the cash flow statement. So, but we say the cash flow the statement of cash flow. That is IAS 7, International Accounting Standard number 7. Then we can also talk about it can be used to ascertain the value of the business. It can be used to ascertain the value of the business. It can be used to ascertain the value of the business. And then the last one, number 5, it can be used in decision-making process. By the users of this information. So the keyword here is the word users. So the users of this information are very, very important. They are very, very important when it comes to the decision-making processes. So number 3, the next item we are going to talk about is the element of the financial statements. Elements of the financial statements. So elements of the financial statement. That is number 3. Elements of the financial statement. So elements of the financial statements, these are the parts which forms the financial statement. So these are the parts which forms the financial statement. Now, before even we continue, let us define these items first. Before even we can go to the elements of the financial statement. So let us define these items. Number 1, let's talk about what is financial position. Number A, financial position. This one, financial position. So what is financial position? And we say it reveals information about the economic resources. It reveals information about economic resources. So it reveals information about the economic resources that the entity control. that the entity controls. That is correct. It includes, you can say, it includes, so it can include the financial structure, financial structure, its liquidity. Okay, we have its liquidity, solvency, and its ability to change, and its ability to change. Now take all those items. That one is correct. So when we talk about the financial position, we are talking about the information about the economic resources that the entity controls. Now, those information is, for example, we have assets, we have equity component, and so on. Those are the financial position. Then number B, financial performance. Financial performance, and we say financial performance refers to the return generated by the economic resources. Refers to the return generated by the economic resources that the entity controls. For example, the company can use its economic resources, for example, the assets, to generate revenue. So, i.e., use of assets to generate revenue. It's a good example of the financial performance. Let us talk about the reporting entity. You can also find something to do with the reporting entity. So what's a reporting entity? Refers to an organization or unit. So this is an organization. Refers to an organization or unit. So this you can talk about the organization or unit that prepares the financial statements. That prepares the financial statements. For external use. For external users. According to IFRS, we should talk about the IFRS data. So IFRS means International Accounting, International Financial Reporting Standards. International Financial Reporting Standards. So that is now the elements. So elements of the financial statements. Number one, we have the assets. So we have the assets. Okay, so let's start with the assets, and we say these are resources owned and controlled by the business. These are resources owned and controlled by the business or the organization. So these are the resources owned and controlled by the business as a result of past events. And from which future economic benefit is expected to flow to the entity, and from which and from which future economic benefit. We call them the inflows. We usually call them the inflows. Money in. That's the money in. Are expected to flow into the entity. Are expected to flow into the entity. Now, if an asset cannot generate revenue, in most cases we cannot categorize them as an asset. So assets is any item which is controlled by the entity and it can be used to generate revenue, or it can be used to generate future economic benefit. For example, a revenue, it can be used to generate revenue. Revenue generation is a future benefit, a future economic benefit that it is derived from using of an asset. So if you use an asset today, then we use that asset to generate revenue tomorrow. For example, we can use if we have land. Land. So land is an asset. We can use land to plant crop. Then in the future we sell those crop to generate revenue. So that future benefit is what we call those future benefit derived from an economic resource. That resource is what we call it's called an asset. We can use, for example, a plant or an equipment. Plant or an equipment. For example, a machine. A machine can be used for production purpose. It can be used to produce or to manufacture the final product. For example, if you are in a industry where we produce juice, something like that. So the machine can extract juice from the fruits. So that juice that is extracted using the machine, that juice can be sold to generate revenue in the future. So that machine can be categorized as an asset. That's number one. Number two, you don't need to stay there. Another element is number two. Let's talk about the liabilities. Liabilities, and we say refers to the present obligation. Refers to the present obligation of the entity. Refers to the present obligation. Of the entity. So refers to the present obligation of the entity arising from past events. Arising from past events. And the settlement which is expected to end, because as an obligation, remember for an obligation you need to do what? To repay. So the settlement is expected to result in an outflow. Outflow means money out of the economic benefit. That one is correct. Now, when you talk about an obligation is a liability. Now, remember, a liability is a debt. So, you need to repay our debt. Now, the debt comes because of past event. For example, you cannot have a debt that you in the future, like you had a transaction with a person in the future, then you did not pay that person. It is either you had a transaction with that person in the past. For example, yesterday you had a transaction with someone, then you provided services to that person, but that person did not pay you. So meaning it is a result of past event, not future event. So that's what we are talking about. Refers to the past. We refer to the present obligation of an entity arising from past event. So it must be from the past event. And when we settle or when we pay, money will come out of the organization. So for asset, money will come in. So the benefit will have an inflow. But this one, the economic benefit will be an outflow. We are the one paying now. So the settlement is going to result to an outflow of the economic benefit. Benefit. Number 3 is equity. Number 3 is equity. It holds an equity. And equity refers to the residue interest in asset. Refers to the residue interest in asset. Refers to the residue interest in assets. So refers to the residue interest in assets of an entity after deducting liabilities. So the keyword is what remains. So the keyword is what remains. So what remains is what we call an equity. So once we pay all our debts, it's what we call an equity component. We can look for the other items. So and then we have other 2 items, that the income and expenses. This one we shall define them later. These 2, but this one is these are the components of the income statement. Then these 3, assets, liability, and equity. These are the element of the balance sheet. So assets, liabilities, and equity, they are component of the statement of the financial position. Then income and expense, they are component of the income statement. Let's talk about the basic accounting equation. Basic accounting equation. And what is the basic accounting equation? So this is the definition of the basic accounting equation. You can say that this is the foundation of double entry bookkeeping. So this is the foundation of double entry bookkeeping, and it shows the relationship between assets, liabilities, and equity. So that is all about the basic accounting equation. So it is a fundamental of the double entry. Now remember, double entry, we say for every transaction there must be a debit and a credit. So once we do a transaction, there must be a corresponding debit and credit entry. So you can say for double entry, there must be a corresponding debit and credit entry. That one shall do it later. For now, you just know that for every transaction we need to do a debit. There is account that will be debited, and there is account that will be credited. Now this is the simple basic equation. Assets equals to equity minus liabilities. So this is what we shall be using until you finish the accounting. So that is what we shall be using until you finish the accounting the accounting these accounting topics. Now, once we have done with the basic accounting, there's nothing else there. We can talk about the users, which is the last topic of topic 1. Users of financial accounting. Of financial accounting. Now, the users of the financial accounting. So we have a lot of them. There are quite many users of the financial statement. Let us talk about number 1. Management. So number 1 is the management. So the management uses this information for the purpose of planning. So we can say the management use accounting information for the purpose of planning. For the purpose of, we can talk about the purpose of, for the purpose of planning and decision making. Process. So they can use the information provided to help them make to make decision and also for planning. Then number 2, we have potential and existing shareholders. Those are also users. Potential and existing shareholders. Potential and existing shareholders, and we can say, let me check. We can say that they need the accounting information to assess the risk inherent. So we can talk about let me use this one, which seems to be more better. We can say that they require this information. They requires this information. They require this information about profit, dividends, and then prospects in connection with the share price, to know if they can subscribe or sell their shares in the company. So remember, I talk about shareholders. Shareholders are the people who hold shares in the company, and therefore they need to know the information about the dividend payment, the profit that the company made, what is the share price of that company, so that to know if they can still hold their shares or they can still sell their shares in the company. Number 3, let us talk about the employees. Employees, these are the people who are employed by the company. So why is it important for them to have this information? So they need to know they need to assess the information so as to determine their term of the employment. So they need the accounting information for the purpose of assessing their term of employment. So they need this information so as to assess their terms of employment, so as to assess their term of employment, so as to assess their term of employment. We have lenders. Those are the people who give loans to the company. Lenders. Now they need to know if the company can easily repay their loan. So lenders. So they need the accounting information to assess if the company can repay back their loan. So they need the accounting information to assess whether the company can repay back their debt. That is correct. Or they need to know to use this information to see if they give loans to the company, can the company pay back in time. So that's for the lenders. We can also add another one, customers. These are the people who buy goods and services from the company. We call them the customers. Why do they need this information, customers? Purposely, they would like to know the business is performing. They would like to know how the business is performing and its financial position. Now, this information enables them to assess whether they can rely on the firm for future supplies. So, definitely, they need the accounting information to assess whether the company whether they can rely they can relate to the company for future supply of goods. And services. Will that company be able to provide the same goods from time to time? If yes, so they need to use that information so as to make those decisions. So they need the account information to assess whether they can rely on the company, supposed to be on the company, they can rely on the company for the future supply of goods and services. So we have others. Government agencies, for example. Government agency. For example, the KRA. Now, government agencies rely to this information to determine the amount of tax that the company is supposed to pay. So the government agencies rely to the accounting information so as to determine or to know the amount of tax the company is supposed to pay. The amount of tax the company is supposed to pay. We have the public. The public also. Number 6, the public. You can go and find why do they need this information. We have the public. We have the investors. Number 7. You have investors. So those are some of the users of this financial information. So topic 1 of the financial accounting this is what we were required to do. Topic 1, we are supposed to come up to study nature and the purpose of the financial accounting. That is it. We have talked about the nature and purpose, the objective of the financial statement. We also were supposed to talk about the element of the financial statement, just in brief. We talked about it. We also supposed to talk about the accounting equation, the basic accounting equation. Here it is. And then we are supposed to talk about the users of this accounting information. So that will mark the end of topic 1 of the financial accounting. So when we meet in our next class, we shall meet so that we can do topic 2. So topic 1 is called the introduction to accounting, or the financial accounting, introduction to the financial accounting. That is topic 1. So when we meet in our topic 2, we shall talk about the regulation and other principles. So topic 2 shall be, this will be topic 2, regulation and other principle. So topic 2 will be regulation and other principles, principles. So regulation and other principles, guiding accounting profession, guiding accounting profession. So that will be topic 2. So topic 1 is over. So let us meet for topic 2 in our next class.